the markets increased so much, global asset allocation, the views from Alpine Macro and MRB, an analysis on the oil market, also from Alpine Macro, last but definitely not least, the outlook for the US. It's incredible that the MSCI All Country World Index has moved even higher than it was before the war started. And that's despite the geopolitical uncertainty and the oil price being more than 50% above pre-war levels. And the reason for that is because of incredibly strong earnings growth. The markets are now pricing in close to 20% earnings growth this year, i.e. over the next 12 months, for the global aggregate. A similar earnings growth for both the US and the global ex-US benchmarks. But the prize goes to emerging markets. And emerging market earnings are expected to increase over the next 12 months by 35%, aided by extremely strong gains in those tech companies in Korea and Taiwan. Alpine Macro, they have equities at overweight. They cite structural productivity gains and a cyclical acceleration in global economic activity. Both of those factors supporting profits, with monetary policy also still accommodative. Emerging markets, according to their thesis, should outperform on AI diffusion, higher metal prices, and a manufacturing upswing supported by easier financial conditions. And in terms of bond markets, the sovereign bond market should benefit from a fading oil shock combined with a likely return to a more accommodative Federal Reserve stance, which should see the US 10-year Treasury yield retrace back towards 4%, which is where they stood at the outset of the conflict with Iran. MRB on their asset allocation recommendations. This is a report written on the 1st of May, so it's very current. And I quote, "Our best case scenario is that the Strait of Hormuz will open reasonably soon. Commodity flows will gradually normalize and the global economic expansion will be sustained. Accordingly, we favor a moderate tilt towards equities versus bonds on a 6 to 12-month horizon, albeit complemented by overweight exposure to cash." And they add that credit spreads are back near cyclical lows, even as bond yields and oil prices are at the upper end of their recent range. So that tells us that all is well. The credit spreads are one of the most important barometers for the health of the global economy and corporate profit growth and balance sheets. On the Strait of Hormuz, the timetable and results of the negotiations between the US and Iran are uncertain, but both sides have an incentive to wind down the war reasonably soon, which we assume will include a full opening of the Strait of Hormuz and a significant decline in oil prices. In terms of interest rate policy, the monetary policy and fiscal backdrop remains positive for global growth and risk assets, although investors are expecting modest central bank rate hikes in the next year across most developed market economies. And this is a crucial point. However, real one-year forward expected policy rates for the major developed market economies are very low and do not threaten the global economic expansion. So the real rate is the nominal rate, expected nominal rate, less the expected inflation rate. And then staying with MRB equities, a further rise in corporate earnings should propel stock prices higher in the year ahead, although returns will be constrained by already elevated valuations. But maybe we won't have quite the same gains in equity markets as we had last year, but nonetheless, they are expected to be positive. Now we're going to turn to the outlook from MRB on the oil price. Spot Brent prices briefly topped $120 per barrel in the past week, given a lack of progress in non-formal negotiations between the US and Iran. That said, Brent futures 12 months out remain at around $80 a barrel. So that's a whole $40 per barrel less than the spot rate, implying that investors ultimately expect a gradual normalization of oil flows from the Middle East. On the 1st of May, the UAE withdrew from OPEC after a membership spanning 58 years, expressing its intention to boost output down the road, which should help bring oil prices down once the strait is open. A look at the US dollar. The dollar had been seriously oversold, but that oversold condition has fully unwound. The failure for the dollar to rally more during this geopolitical crisis represents an underlying weakness in the currency. Just a couple of observations. The US economy is strong. Those high-frequency economic data growth points show indeed an acceleration in growth, which is surprising. The economy is bolstered by fiscal stimulus, the One Big Beautiful Bill Act, easy monetary and financial conditions, and of course, continued AI-driven investment in Capitec. In terms of US earnings growth, analyst earnings forecasts have continued to rise throughout the conflict in every sector of the S&P 500. So even those laggards previously, the energy sector in particular, those have joined the party. Looking at the earnings from hyperscalers, so far the hyperscaler group's CapEx splurge seems to have been worthwhile. The earnings show that the CapEx splurge has been accompanied by growing cash flow as rising AI-related demand has boosted profits. Analysts expect cash flow to keep growing strongly. Demand for AI seems to be strengthening. In such circumstances, it's not hard to imagine CapEx remaining strong or even picking up more steam. And then turning back to Alpine macro on the US economy, labor markets are sending disinflationary signals that are bullish for profits and could restore expectations of interest rate cuts later this year. Average hourly earnings growth is at a 5-year low, and productivity increases have pushed unit labor cost growth below price inflation, and that is a rare occurrence over the past decade.
So on the local market update this morning, there's mainly 3 sections we'll cover. The first one is a macro overview with some political highlights also in there. The next section is JSE performance and looking at some of the performance of the indices and the JSE year to date, also some winners and losers. And then we'll end off with results and trading updates, which is mainly Capitec. It's one of the holdings in our portfolio. Jumping to the macro side, as Nick also pointed out, the main macro theme for April and still ongoing has been the war between the US and Iran, the Middle East, and the resulting oil shock from that. As South Africa, we've felt that pretty severe. If you add the increase we'll get today for petrol and diesel, and you look at the increase since the beginning of the year, and most of those gains have come over the last 2 months, has increased almost 30%. And then diesel close about 74%, going from around 18.40 to about 32 Rand. Also depends on if you're on the coast or inland. Sure, this will obviously have a major impact on expenses for consumers, for businesses and so forth. So definitely a short-term drag on the South African economy, and it will put some pressure on the recovery we've seen over the last 18 months. I think the million-dollar question is, what is the impact of the higher fuel cost on inflation and what will happen with interest rates? We had March CPI, we're waiting for April's CPI or inflation figure. The March figure was still fairly close to the new 3% target, came in at 3.1%. So not too much to read into that. However, inflation is expected to tick up given those fuel costs. South Africa is a net fuel importer, oil importer, and given that there's a lot of road transport that occurs in South Africa, it's got a direct impact on cost. The interest rates, we came into this year expecting interest rate cuts, anything between 50 basis points to about 75 basis points. However, it seems like that is completely off the table at this stage. There's discussion regarding if the South African Reserve Bank would look through the shock or if they would increase rates. They tend to increase rates, especially when inflation expectations go up, not so much inflation. But at this stage, it seems like there's a high probability of a potential rate increase. I listened to an update from quite a fairly big asset manager in South Africa yesterday, and they were forecasting around 325 basis point hikes for over this next year, with 2 occurring this year. So if that occurs, it's not good news for consumers or businesses, but definitely something to keep an eye on. April was quite a busy month on the political front. I do think, given everything that's happened, it's worth just quickly highlighting. I'm sure everybody's seen a video of Mrs. Helen Zille campaigning fiercely in Gauteng for the mayor of Joburg. Either a video where she's canoeing in a self-made little river or a pothole or playing tennis on a tennis court filled with weeds. But that's expected to intensify the campaigning between the different parties, and will most probably put some pressure on the GNU as well. Then there was an amendment to the Public Service Act. And the reason why I'm highlighting this is it was in a report by the BER, and they noted that it's after the Constitution in 1996. This is probably one of the most significant legislative developments that we've had since then. So I'll just read this note quickly. President Ramaphosa signed into law amendments to the Public Service Act, widely regarded as one of the most significant legislative developments since the 1996 Constitution. The amendments aim to professionalize the public service and limit political interference. The legislation sees administrative authority from human resources to recruitment and appointment shift to ministers and MECs at the provincial level to departmental heads. It clarifies the line between political and administrative functions within departments and prohibits senior managers and administrators from holding office within political parties. A provision aimed at reducing party political influence within the public service. Importantly, the legislation strengthens the role of Director General in the presidency in overseeing senior appointments across government. So very important legislation that's been signed into law, and hopefully it will result in much more stable local governments. Then our number 1 cop in South Africa, Fani Masemola, has been charged, and this is a result of the Mlanga Commission. He's been placed on, or he's been suspended, and there's a new police commissioner currently in his place. I'm sure everybody's aware of Julius Malema that was sentenced for firing a gun in public. And then quickly, the ANC and the SACP, South African Communist Party, which is part of the tripartite alliance. The SACP has decided to contest the local municipal elections independently, and that's created friction between the SACP and the ANC. And what has happened now is you, as a member of the SACP, or the ANC, you're allowed to have dual membership, and that's now been taken away. So I think that'll put further pressure on the results of the ANC in the local municipal elections. What is the outlook for South Africa? I think nobody knows. It all depends on the duration of the war. As a small open economy, that's a net oil importer, the higher oil prices does have quite a big effect on our economy and financial markets. And if it continues for longer, the impact will be more significant. However, if it's a short-term shock, I think it'll be a short to medium-term headwind, but won't really detract too much from the recovery we've seen. Jumping to the JSE has been quite volatile. This is just a chart over the last 6 months from November until sort of early May. You can see the big drop there in the middle. The JSE had a stellar start to the year, mostly driven by commodities in the form of gold and platinum miners. And then once the war started in the beginning of March, it was quite a significant drop. I think the drop was around 17% from the highs. After that, quite a decent recovery and a bit of a pullback in the last week and a half. Year to date, the JSE is down about 0.7%. So yeah, not, I think, bad for what we've seen over the last 4 months. However, compared to where we were over the January and February, it's been quite a bit of a decline. Just looking at some sector performance, there's 10 main sectors as we've reported on before. And I'll just highlight some of the performance for the year to date. You can see the biggest loser there, technology, down 18, almost 19%. This is mainly Naspers and Process, which is a core holding in our portfolio, and then also most South African equity or multi-asset portfolios. Naspers and Process have been sold down. I don't think I've heard one analyst portfolio manager say that it's something you should sell out of. Everybody just feels it's been discriminately sold off along with the earlier because of this AI scare. Then consumer discretionary also struggling, down almost 11.5%. That includes things like clothing, footwear, cars, luxury goods, and so forth. You can imagine when there's uncertainty, these more luxury items are put on hold. One of the big shares that's dropped, that's a big part of that index, is Richmond, the Rupert luxury goods company. Just looking at some of the better performing sectors so far, as you can imagine with oil prices where they are, energy has shot the lights out, up 26%. And this is mainly 3 companies on the JSE. Sasol, which benefits from higher oil prices, and then coal miners also included in this. So in the form of Exxaro and Tugela, we don't own any of that. That's also done well. We do, however, own Glencore, which falls under basic materials, but Glencore's got a big portion of their earnings coming from coal, and they've also benefited from the recent rise in coal prices. Then telecommunications, mainly driven by MTN, up 16, almost 17%. Healthcare, it's also done reasonably well from a very low base. There's only about 3 companies in there. And then I think just something to mention, basic materials has been the main driver of returns on the JSE last year and in the beginning of this year. It's still up close to 3.2%, but far of the highs of earlier this year. And this mainly includes the gold miners and the platinum miners. And you've seen gold come down from about $5,400 per fine ounce, dropped to about $4,400, and it's close to about $4,700 per fine ounce. Platinum, the same, came down from about $2,500, just below $2,000 per fine ounce, and it's just hovering around $2,000. Some of the winners and the losers, I won't go through all the lists, but just to highlight, as we mentioned, Sasol, part of the energy complex, up 118% from a very low base. Tugela, which is a coal company. Glencore, we own, up 40%, which has done quite well. Some of the losers, it's quite a mixed bag. Sappi, Pick n Pay, Clicks, which tends to be a darling on the JSE. Process, we talked about. Afrimat, something we own. Harmony Gold, and then We Buy Cars, Banya, which is again a general miner, and Bytes, which is a technology company. We had Capitec as a big part of our local portfolios, and they reported full year earnings, as mentioned earlier. I'm just quickly going to highlight 1 or 2, I think, important facts from the results presentation. This company just ceases to amaze, or never ceases to amaze. Earnings was up 23%, and their current earnings, headline earnings, is 16.8 billion rand. Massive number. And this is growing earnings 23% in quite a tough local environment is just absolutely amazing. They've got about 26 million clients. If you think South Africa's population is close to about 65 million, not all as adults. So yeah, quite a big part of society, if you want to see it in that way. Fully banked clients, people that use Capitec as a main banking app, almost 10 million clients. Capitec's a bank, but I think these days it's almost more of a diversified financial service company, because 67% of income is non-interest, which means it's not from lending out money, which is traditional income stream of a bank. Return on equity, phenomenal number, 31%. So every rand they invest of their own money, they generate a return of 31%. Amazing. Looking at the right-hand side, that's just a breakdown of that 16.8 billion rand profit they make. You can see 41% is personal banking, 5% business banking, which is one of the areas that is growing significantly. So give or take, just slightly below 50% is banking, and then 27% insurance, funeral policies, life insurance, so forth. And then fintech, also a big part of the earnings, which includes Capitec Connect, basically a telco or selling airtime, and then value-added services, payments, forex, and so forth. This is the share price chart of Capitec over the last 5 years. If you look at it over since the start, it's phenomenal. I think it probably looks better than a Nvidia share chart. But yeah, it was trading at around 1,600 Rand 5 years ago. It's close to about 4,300 Rand currently. We bought it just after the tariff tantrum last year, around, I would say, 3,300 Rand. And we've made some good gains.
I'm very glad that we've got lots of Capitec in our portfolios, and also the local investment strategy of having around 40% in offshore or global index ETFs. So that really makes our portfolios quite unique on the local side.